Good afternoon, ladies and gentlemen, and welcome to the webinar on GST Audit organized by ASA and Associates LLP. To start with, all the participants' line will be in listen-only mode. Post that, we'll have a Q&A session. So now, without any further delay, let me over the session to Mr. Subroto Bose, Executive Partner, ASA and Associates LLP. Thank you, and over to you, sir.
Hello, everyone. I start the presentation of today on GST Audit, which all of you know is now the hottest topic in India. Why is it so? GST compliances, we have seen all through the years, it's been a tough time for all of us. But the initial tough times are now slowly ebbing away. We are now in a situation wherein the compliances can be easily handled. But what we have now is GST Audit, which is around the corner. To give you a brief idea about GST Audit, what to expect, how to prepare yourself for that particular audit. Here I am to give you the presentation on various aspects of GST Audit. So let's start the presentation. The presentation has been divided into various parts, and I will take one by one. So the most important, the first slide of my presentation, which is slide number 3, is at whom to apply for. The GST Audit has a requirement that it is applicable to entity which has a turnover of INR 2 million, above INR 2 million. So a company, for example, if it has a turnover or a sales or a service income of more than 2 million, in that case, it will get its accounts audited. Now, this requirement is applicable to all the registered persons. So, all registered persons who are registered under GST with a turnover of rupees 20 million has the accounts audited by an independent accountant or cost accountant. And audit is for the period 1st of July 2017 to March 2018, because GST came into existence on 1st of July 2017. So this time, for the first time, for the past financial year, which is financial year 17-18, the audit will be for the period of 9 months. Next slide, slide number 2. With regard to GST audit, the most important point is what the auditor will do. Now, the auditor has a huge amount of responsibility here to not expressing his opinion. As we all know that the statutory auditors in case of Indian companies have to express his views or opinion on the state of affairs of the company. In GST audit, what the government has mandated is that it cannot be an opinion. It has to be a true and correct view of the position that we are in, or operations of the company in GST regime for the 9-month period from 1st of July 2017 till March 31st, 2018. Now, given this huge amount of responsibility to express a true and correct view, the auditor will of course be needing his documentation. The first and foremost documentation will be the audited financial statements, which is the financial statements as per the Indian Companies Act. So, audited financial statements will be his base to rely upon. Apart from that, he will have his books of accounts, right, again maintained under the Companies Act. All the records and registers which are due under the GST law, which every company has to maintain, as well as the GST annual return. We all know that one annual return has to be filed every year with the GST authorities. And this annual return, the due date for this annual return is again 31st of December 2018 for the financial year 2017-18. Incidentally, the reporting for the GST audit is also 31st of December 2018 for the financial year 17-18. Now, the auditor, in case a company has various locations where it has offices, has business from, then each location has to be audited and a audit report has to be used for, has to be uploaded or filed with the government for each location registration. Why I use the word registration and location? Because GST is, the base of GST is that every registration is an entity up for a GST audit. So it is a company and offices across India, and each office different turnovers. So if the total turnover of a company is INR 20 million, in that case, if it exceeds INR 20 million, then not only one office, suppose one office has a turnover of more than 20 million rupees, only will that registration or that location will be audited, but all locations will coming under the GST audit scanner if the turnover of other locations is less than INR 20 million. So each registration has to be audited and a report to be submitted to the government. We all know from this year there is a new audit which is GST audit. Apart from the statutory audit and the tax audit, India has had been seeing the stat audit and the tax audit for decades now. For the first time, the audit has been added to the list. I now move slide number 3, where it states what all documentation will be required for this particular audit. Now this slide is very important for folks out there. Why? Because this slide has those things in it which the auditor will ask from each one of you before he starts the audit. So what does he ask for? He asks for a complete and accurate set of books of accounts, records and registers made as per the law, the returns that's been filed by the company, including returns, the computation sheets for the preparation of the returns, the audit report, as I said, filed under the Companies Act of India, which is the Indian Companies Act, and the timeline for this to check all these things and report to the government is 31st of December. So we are looking at a period of exactly just more than 90 days from now, wherein the audit report has to be filed with the government. Slide number 4, as to what are the key touch points for GST audit. Now, these are short, the areas which the auditor will cover to report to the government. So he will cover the outward supply. So he will review all outward supplies. He will review all inward supplies and input tax credit availed. He would review the classification for the tax rate. So suppose you're selling 4 products or in 4 services. If they have a different tax rate, he will check whether these are appropriately classified as a tax rate as per the law. Then we'll review the tax paid on the outward supplies. He will also has to comment in case the tax paid is less than the tax payable. According to him, would more than the amount of tax paid, so he has to comment on that Also, and in case there is a liability to pay tax, company has to pay it. So that's there in the audit. That's part of the audit reconciliation statement report that the auditor has to file. Then to review in the course of audit the transitional credit. We all know the transitional credit is a very important component of the input credits. So the Tran 1, the Tran 2s, and he will review all the records, the registers, the documentation, the compliances, which are the returns that the company has filed, could be filed in annual return. So these 7 are the base with which the auditor will go about in his business and then issue his audit report. What next? So in subsequent slides, I have tried to give a bird's eye view as to what the auditor will review in each of those items that I had captured as the key touch points. Now, you see outward supply, see the proper classification, I have already said. See whether the supply is under forward charge or the reverse charge as per the law. He would check the time of supply and the place of supply regulations. We all know that time of supply determines when the tax liability was to be deposited with the government. And so supply determines the nomenclature of the tax. And both of them are crux by way of your tax liability to the government. From this, there is a very important provision that auditor will look into, which is Schedule 1 supplies, where supplies made without consideration. In India, this is one of the hottest topics going on once again on GST. Within the GST is how to value such supplies. Now, the auditor will use his judgment, the law before him, and also whatever clarification comes during the course of this period. He issues his audit report and files it by 31st of December. Go to slide 6 on review of inward supplies. Extremely important, as we all know that tax credit is split into one which is eligible and one which is not eligible. So auditor has to weed out those and see what is eligible and whether the company has taken the eligible credit, left out the ineligible credit, or finds otherwise, he has to disclose the fact and accordingly proceed. There is a liability on the auditor to see whether credits are reversed, which were not allowed to the company, and all conditions with regard to availability of input tax credit have been met, and only then the input tax has been taken. The law very clearly specifies the conditions only under which you can avail the ITC. If any of those conditions are not satisfied, then the availment of ITC is under question. And of course, the apportionment of ITC into the taxable supplies and the exempt supplies, so that is also there. If a business has two kinds of supplies, how to apportion the input tax credits into both, into the taxable supplies, is a matter wherein the government has come out with various provisions on how to calculate that and accordingly take the input tax credits. Head to slide number slide number 7 on transitional credit. Now, as I said earlier also, this is extremely important with regard to ITC, the input tax credit. ITC in short, input tax credit is nothing but ITC in short. So Tran 1 and Tran 2 are the carry forward input tax credits from the earlier regime. Now the government itself is closely monitoring this transitional credits, and most of you would have already filed your transitional returns. Of course, the dates are over, so definitely would have filed them. These are to be verified, will be verified by the auditors to check whether proper input tax credit has been availed or not. Slide number 8 on view of records and registers. As mentioned in the first slide, the other, along with the books of accounts, audit financial statements, the annual returns, will also have the accounts and record rules under GST, will check all invoices, the debit notes, payment vouchers, receipt vouchers, delivery challans, and of course the e-way bills. Bills are the documentation through which the distribution of goods happen from one place to other, whether in the state or from one state to another state, the country. All the documentation have backing of the law and the regulations behind them. The auditor would definitely check whether all those regulations, provisions have been followed, and accordingly the records have been maintained or not. Come to slide number 9 with regard to review of the compliances. Of course, you have been doing the compliances every month, but the auditor, his true and correct view for the purpose of the GST audit, will directly check all the returns that's been filed, and we will verify the tax liability and the tax paid. By returns, you must have mentioned the documents that you have used or generated particular transactions. Also mentioned them in the return. The auditor would of course check, match them, and then form his view on compliances and report accordingly. Now, till now, I have been explaining to you what the required, what he will check, how you need to prepare yourselves, what all documentation, what is the timeline. Now, number 10, which covers the audit report and the various reconciliation statements. Form GSTR 9C is form has been divided into two parts. One is the reconciliation statements, and the second part is the certification based on those reconciliation statements, plus the mandatory assurances that the government wants from the GST auditor. Now, the reconciliation is to be done in the company. Auditor would review those reconciliations. That is mentioned in the form GSTR 9C, and accordingly will come to or form his views about the reconciliation. And as the subsequent slides will show you, reconciling difference will be there between the audited annual financial statements and annual return of GST. These side items have to be clearly put forward in the reconciliation statements and commented upon, meaning that the auditor will be going reasons the company will provide for all those reconciled items and express his thereon. So the certification part, the part B, there are two formats to it. In fact, there are two formats to it in the certification. One wherein the reconciliation statement is drawn by the person audit, other than the person who conducted the audit. So, if the auditor is going through the work of somebody else, then the government has specified a certain kind of a report, and if the auditor is drawing the reconciliation statements, that has accordingly made or sort of enumerated or even in the GSTR 9C. Now, reconcile. The few key areas of reconciliation that has already been discussed, but I would like to take you through them with very obvious reconciliations. The first one of them is in slide number 11, the turnover. Now, the reconciliation of the turnover declared in the audited financial statement and the Companies Act, the state audit I am referring to, and the turnover declared in the annual return have to be reconciled. And as I said earlier, there are differences between the two. In that case, difference for the same has to be reported. This is extremely important thing no India had before. Come to slide number 12. Statement that has to be drawn with regard to the tax that is actually payable. Depending upon the classification of the goods or services, the rates are classified accordingly. 5, 12, 18, 28, and on forward or reverse charge. RT in this slide is reverse charge, wherein the recipient of the service has to pay the tax. So the auditor has to review tax liability is actually what it should have been. There is a discrepancy. Auditor, there is excess tax liability coming out of his own reviews, to report that along with reasons thereon. And the reporting that has to be done, the tax along with the interest and the, if any, paid also. Company. Coming to slide number 30, the reconciliation statement, so to say. So already saw two reconciliations, one on turnover and one on the tax payable. The third is on the input tax credit or ITC. Now, reconciliation for the input tax credits also, and if any differences arise in the reconciliation, again in the annual return under GST, the statutory audited financial statements. I repeat, the reconciliation between the statutory audit financial statements and Indian Companies Act versus the annual return under GST. If there are any reconciling differences, those differences have to be verified by the auditor. In fact, will on examination also find reconciling differences, and that then same has to be disclosed and tax liability, if any, has to be paid. So if there are input tax credit utilized, which should not have been the case, then the liability that arises out of it has to be reported. Now, I captured the three basic reconciliation areas which are the most important and which are there in the GSTR Form 9C. Apart from that, we have certain areas regard to the GST audit and reconciliation statement has been recently notified by the government. Come back once again to where we started on the reconciliation. The reconciliation of the turnover between the statutory audit financial statement declared turnover and the turnover in the annual return under GST. Thing that comes out of the has been notified, the turnover has to be bifurcated. Various registrations. What I mean here is, the annual audited report, you have one turnover figure, all your offices across the country, this is India. When you reconcile this with annual return, the turnover has to be bifurcated registration-wise and reconciled. Point on which there is an area of concern, and now taking the areas of concern only. The other where is there is a huge amount of concern is supply under Schedule 1. Now, Schedule 1 then it supplies without a consideration. It includes supply between this person and related persons. So these persons can be two companies, two branches, two registrations of a company, and is supply between one branch of your company to another branch of your company or the office of your company, which supply under Schedule 1 as per the law, then valuation of such supply, leave indication in the first case of such supply, is a matter of concern. The problem here is of such deemed supplies between two offices of a company as one identified the valuation of such supplies. But still no 100% clarity as to what will be the valuation supplies, but of course a reasonable valuation has to be taken such deemed supplies. So that's an area of concern. The law is not very clear and clarity is expected there from the government. I mean, everybody is waiting for this clarity to be there from the government. What we get in the coming days and weeks and months ahead before the audit report is filed. Apart from these two, the Transitional Credit centralized registration. So there is a point number G in slide number 14 where turnover from the period April to June 2017 is mentioned. Now all of you would remember that this is the period which is the GST period of within the financial year 17-18, because GST came into being from 1st of July 2017. So government allowed the companies, the entities to transition the input tax credits for to June to the GST regime. Now in this, for a company which has several offices and it is a service entity, so it renders services, and it has a centralized registration, service tax. So I am now going to the pre-GST regime. This particular insertion in the GST reconciliation statement, government, where I have one figure of credit for centralized registration company, those has to be bifurcated among offices, and the reconciliation statement can be properly filled. Please remember that this activity has taken place earlier back, and therefore the concern area, in case companies have maintained such detailed violation, each registration under the old tax regime, in this case, the example that I have taken, then not exercise has to be done now. The audit purpose. And and specifically for the reconciliation purpose. If I go to slide number 15, the second concern area. Now, again, on reconciliation between the audited financial statements and the annual return, the input tax credit reconciliation, the clause which says that ITC booked in earlier financial years, claimed in current financial year. So this refers to, once again, the Transitional Credit. This again has to be bifurcated. One was there on 1st of April, the balance for the financial 17, and as the closing balance for the June, which is June 30th, 2017. So the concern here is that the government is asking something very different or something which is out of the blue. The fact of the matter is such details not have been properly maintained by the companies. Now, when the GST audit report is out or notified last week, these workings have to be done for proper reconciliation that is drawn by the company. Leave alone the auditor reviewing it, because the auditor would immediately point this out once he knows the company and is working through the audit. So these have to be worked out by the companies and produced before the auditor. This preparation has to start now, if it's already there. The other area, the reconciliation of, it's a carry forward of the ITC reconciliation only, but now in slide number 16, government has mentioned various expenses, and the expenses has to be first for each registration of GST accordingly per registration. So you have a balance sheet, financial statement, as one expense, or in fuel, for example. It's 210 offices, registration. The bifurcation has to be done, but the able ITC in each one of them has commented upon, and the auditor has to express his views on that. So, if expenses are not classified accordingly as it is given by the government here on this slide number 16, first of the task is to classify them per registration. So, if books of accounts are not geared up for that, be done by each company for each registration. To the list, and the view of the input tax credit, such expenses have to be calculated or put alongside the expenses. We'll check whether these input tax credit are eligible or not eligible. That's a different matter. The issue here is to wherein the credit has not been taken by the company but included in the cost. Now, column number 3 is amount of total ITC. So, every invoice has a tax. Some is eligible, some of it is not. If the company has taken the tax as its cost in its profit and loss account, that has to be taken out from that cost and shown in the column number 3 with the total ITC on this particular expense, and the auditor has to review the amount of ITC that is eligible out of the total ITC that is in column number 3 or disclosed in column number 3. Now, eligibility can differ because the company may take out of rupees 10 as input tax credit on a particular expense. I've taken 10 rupees, but the auditor, just for example, may contradict that and no, this is either not fully allowed or it is allowed. So column number 4 of slide number 16, the relation of ITC declared for various expenses, is a huge amount of it requires a huge amount of involvement, so to say, between auditor and the auditee. The question also here is, in column number 3, what ITC that needs to be disclosed? Is it the ITC that is available? Expense? It is only the eligible ITC. Elections from the government, and we another area is, we have already said that the tax payable, the auditor has to, once he comes to a conclusion that tax is payable, his company to pay the tax. The company has to pay off the tax liability. Now the here is, in particular report that the government has notified last week, what happens in case there is a reduction of liability? They are not covered. And point in the same slide in slide number 17 that I am in is that any amount paid for supplies not included in the annual return. The of concern here is what are supplies that will not be included in the annual return, the return for the full financial year under GST. This particular is what type of supply the government is trying to hint. This is a area of concern. Number 18, what to do is, I like to post the areas of concern in this particular slide. conducting a smooth audit and conducting the audit as per the law, four things that need to be done before the audit can start by every company. Financial statements need to be drawn for registration. The statements have to be drawn for registration. Books of accounts have to be there for each registration. Then, a correct certification is possible, otherwise it's not possible. Sum and substance of the discussion that we are having here and what we had till now is there have to be very robust audit processes in place, and documentation is a very key factor in convincing the auditor to complete the audit and the legal requirements. The audit processes, if not there already, will have quickly started. That the auditor, once he sends the program and the audit checklist, it will include all such things. These should be ready because otherwise the audit can get delayed. The concern areas, the requirements that we have discussed right now are very major. Hence, these have to be quickly complied with before the audit starts. So as my presentation ends, you're free to ask your questions. You can type them in the box and we will revert back to you through audio. So, request the questions to start. Kathuria has a question for us, which says that I believe turnover threshold of rupees 2 crores is INR 20 million will include VAT, service tax, excise turnover for 1, 17, 18. Clarify. Answer is yes. If you see the reconciliation statement on turnover, the first quarter turnover was subtracted from the turnover in the audited financial statement, and it will be a only turnover for the period 1st of July 2017 to 30th of March 2018. Now, Sandeep Prajapati, what are the steps to be taken to get self-invoicing? I answer this question now over a platform which asks me to give you hints or steps to be taken against self-invoicing. I will take it up with you, Sandeep, separately soon. On Primanshu Jaiswal's question, says that we have 10 states of registration, of which 2 locations are below 2 crores, which is 20 million. One remittance in excess of 2 crores received through a central bank account, which is one for all 10 locations. We have to get all our 10 locations or 8. Now the answer to this question, Primanshu, is I said in the very first or second slide when I was discussing that one of the officers has a lesser turnover, less than 20 million, but whether it is more than 20 million. So one permanent account number more than 20 million, then even those 2 officers have to be audited. Sana Krishnan, you said that share the presentation. Definitely do so. Again, Ravi Babu, you have a question on you cannot feed the trans credit now. I will again take this up with you over a one-to-one call. There is some issue in I guess it is a technology issue once again that you are not able to fill in the details. I will back to you and discuss with you on this particular point. We still have around 7 minutes or 7 minutes to go for webinar. So please post your questions. Yeah, I would definitely share the presentation. I was asking for the presentation. Along with Tony, Vijay was also asking. Babu, I didn't get your question. You have written, just a second. The field is not available. I am not getting the question that you're asking. Clarify. Then Ajay Kumar is asking, does any company need to show in column number 3 when ITC was not taken and expensed in profit and loss account? Yes, it shows. The column number 3 has to be filled up with the amount of ITC, so that was the concern area. D, which is still there, supposing included in the cost, that has to be taken out and disclosed in column number 3. pertaining to that particular expense. Kumar again is asking slide number 6, proper apportionment of the second. I am not getting the question. Let me quickly see this. Proper apportionment of ITC. What is the meaning of proper apportionment of ITC in zero rated supplies? The apportionment that we were talking about in that was related to taxable and exempt supplies. With zero rated supplies, it would not happen at all. Now I go to Jayaraman is asking, will you take ITC credit from 2A or from books of accounts from it? So the ITC reconciliation will happen to the audited financial statements with the annual return. Audited financial statements is the company's audited financial statements. So therefore, the reconciliation will happen with the books of accounts only and not way. Swanyam Konduri is I didn't get your question, which you say that means they accepted the input of excise duty, VAT, etc. Now no issues will be there on that. Mrs. Subramaniam, if you can specify that a little bit more, or I can get back to you because I am not getting the questions. Now no issues will be there on that. I need to relate that question to a particular topic slide so that I can answer that, but I cannot relate to that. So I'll take up that with you. Babu, you are asking for the presentation. That's fine. Will be shared with you. And Subramaniam, you're writing, so we transferred the ITC of excise duty and VAT and service tax, utilize the same by exporting under rebate. I am still not getting it, but as I said, I would catch with you one-to-one, and this evening only I will give you my answer to it. Babu, you are saying data field in Tran 1 is not available inside. That's an operational issue. Unfortunately, I cannot do anything about it right now. Ajay, and then I have a question. 704, just a second. Early 704 VAT audit was mandatory, as VAT was there for 3 months. Whether 704 is mandatory, kindly clarify. I don't think so. It is mandatory, but again, I get back to you. You are asking a question. In my company, there was no turnover in the year 17-18. Newly incorporated company, and that too in project stage, so turnover was nil. But was FD interest of 2.5 crore? No. Whether GST audit is required in this year? So, have you taken a GST registration? No, you're right. My answer to it will be yes. If you have taken a registration, then yes, the aggregate turnover definition under GST includes exempt turnovers as well. So in that case, it will be you have to have the audit. So I think this was the last question of the day. I don't have. I have a question where it says that K. Venkateshwaran, dear Sir, impact and treatment in audited financial statements based on some findings. GST, dear. I didn't get your question. You said, dear Sir, impact and treatment in audited financial statements based on some findings during the GST audit. You have to clarify this question. If you take the input less than actual wrongly, can we claim or adjust? So that's September 30th that you have to do. Till September 30th, you have to check or review your books of accounts and claim whatever ITC you not claimed already. So that is there. Sanjay Wadhwa writes, will you share this presentation with all or will share on request? I would definitely share on request, Mr. Wadhwa. Venkat was, dear Sir, impact and treatment in audited financial statements based on some findings during the GST audit. See, the audit takes place after the audited financial statements are through. So, it can be next year only, not before that. If Raja says, and I'm running out of time now, this is probably the last question that I will take, and then you can mail me at numbers or call me at the numbers. So the numbers are there on the screen. But if supplier invoice detail not reflecting in GSTR 2A, how to carry out audit with difference? That's a very good question. Once again, a very operational issue. The reconciliation has to be between the books and the return. Now, something is not there in the 2A. We'll have to I mean, definitely fight for it, of course. And of course, our suggestion will be to get all your ITCs checked before September 30 and accordingly close the return for September by October 20th. If something misses out, yes, of course, the only way is litigation. Fine, I think there's no more questions now. Thank you all for patiently hearing this out, the very important topic of GST and the reconciliation statements that had come out last week only. So look forward to your questions, and I'll share the PPT on request. And my email is there in the this thing, and your email, of course, will be more than welcome, and I'll reply back to you. And I'm just sending you my email as well. Is there in the slide. I've shared the mail ID also. Thank you all for being a patient listener, and happy GST audit. Thank you.
Thank you. It was insightful in the session, and thanks participants for joining. This does conclude the session for today, and you all may disconnect your line now. Have a great evening ahead. Thank you.